battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right. Thank you, everyone, for joining us today for our live recording of our 2024 mid-year market outlook. I'm Audrey, a vice president here at Stenger Family Office, and this is a live recording of the Nick Stenger Show for episode 153, and some of our highly rated shows, our most highly rated shows of the year, are Nick's annual market outlook and mid-year market outlook, which he will be presenting today. After Nick is done with his monologue, I will be back to host the Q&A. So thank you to those who have sent questions in ahead of time, ahead of today's call. If you haven't had a chance to submit your question yet, please go ahead and you will be able to submit it in the Q&A section below. So it's right at the bottom. There's a banner there. Submit it in the Q&A section and we'll be sure to answer your questions. So thank you so much for joining us again. One of the things that we are most proud of at Stenger Family Office is bringing you tomorrow's news today. And while most of Wall Street went into 2024 extremely bearish, Nick and our investment committee remained bullish. And we made a base call, which is contrarian. It was a contrarian call at the time. So during the 2024 market outlook call on December 12th, 2023, Nick gave his annual outlook for the S&P 500 with the base being 5,200 points. And if you're looking at the markets last week or looking at them today, you'll notice that the S&P is at 5,480 with a return of over 15% for the year. So if you're not getting these insights into your inbox, make sure to subscribe to the Stenger Family Office content on YouTube, Spotify, and Apple. So with that, Nick, tell us where the markets are headed for the rest of 2024.
Hey, Audrey, thank you so much. Appreciate the info. Thanks, everyone, for jumping on live show here, episode 153. We are rolling our way right to a 200. So we did the big 100 episode special. Next big one will be 200. We took a few weeks off here, but we are back. And I think we'll take next week off with the 4th of July. But we're going to do things a little bit differently for this mid-year outlook show and show you some slides. So we'll do something very similar to what Audrey talked about with the outlook going into this year, and tell you really where we think 2024 is headed the next couple of months. Markets have obviously done incredibly well for 2024, still some baseball to play, but I do think markets in short are going to continue to do well the rest of the year. And then especially going into next year, 2025, really where I think things are headed. And so Audrey had mentioned that most of Wall Street was extraordinarily bearish going into this year. And you had top firms like Morgan Stanley, you had JP Morgan, you had UBS, you had a number of leading analysts on Wall Street calling for doom and gloom this year. And so far, it just hasn't happened. And I just want to break this down. And for those of you who we've talked to individually now in our review calls, our check-in calls this year, I've mentioned this, but I just want to make this very, very basic. How did we get it right? How did we call that the market would be up this year? Market's at 5,400 points. We said 5,200. How did we get that call pretty much right when everybody else got it wrong? And it's just this basic equation. I call it market math 101. And it's a simple equation of multiplying two things together. That's earnings times price. And if you understand this equation, it's going to make investing a whole lot easier. So if you're going to take one thing away from today, just make sure you understand market math 101, earnings times price. And so what I've done here is I've taken a hypothetical company, and in this hypothetical example, a company's making about $100 million in revenue, and their expenses are about $85 million for the year. and their net income, what they actually earn in profit after everything's taken out, taxes, depreciation, interest expense, everything that you could think of, paying their people, buying the stuff that goes into their products. This company makes a $15 million profit for the year. And so the big question is then, what do you multiply? What's that profit worth in the future? What do you multiply 15 million times? So what I want to do is just take the average S&P PE ratio, price to earnings ratio, on a go forward basis of 20, multiply it by 15 million, which is their earnings. And we're going to end up with enterprise value, or you could even call it market capitalization, what the company is worth, of $300 million. And so this is a very simplistic, easy way to understand why the stock market trades at 5,400 today. And I will argue in today's presentation that it's not a fugazi, it's not fake, it's not built on this fantasy of just interest rates or the Fed holding up the market or anything like that. The market is based on reality of fundamentals. And that's what's going on here with this hypothetical company. And so what happens is this equation is then discounted or affected by two things. And one of the things you've always heard me say on these calls, on these shows, you heard it at Investor Day, is that markets discount the future. So if you're going to have two takeaways from today, number one is going to be that markets are a simple math equation, earnings times price. And then the other big takeaway is that markets discount the future. And so we don't really care as investors about what happened last year. We really don't care about what's happening next quarter or next week. What do we care about? We care about, is this company going to be around for a while? Is it going to produce growth? Is it going to continue to produce profits that support a 20 price to earnings ratio? And so that's what markets really are focused on, is those two things: next year's profits, not this year's, and next year's interest rates, because we always discount today's profitability on the S&P by what's the 2-year treasury at. That's really the benchmark. And so if you can really understand the fundamentals here, if you can understand the basics, again, it's just going to make it so much easier to understand where things are going. And so what happens is because markets discount the future, because things already are discounted mostly today, the bad news is basically already priced in. Now, not all of it, not every single piece of it, but a lot of the bad news already gets priced in now. The only stuff that doesn't get priced in is geopolitical things that shake up markets. Maybe there's some sort of major black swan event, is what we call them, like 08 and 09, or COVID, stuff that most people can't see coming. But for the most part, outside of black swan events, a lot of the bad news is already priced in today. So if you think something bad's going to happen next year to tech stocks, or you think something bad is going to happen to energy stocks, or you think that the price of oil is going to go up, or you think it's going to go down, well, don't get too tied into that belief, because chances are, if you know it, almost all of Wall Street knows it too. The bad news gets priced in early. And so what Warren Buffett made a career on is being a contrarian. And that's what Audrey mentioned too, is that we made the contrarian call to basically be bullish this year. And so when everybody's jumping off the cliff together, and I tell you this too, like your mother taught you growing up, if everybody's jumping off the cliff, are you going to do it too? And so the answer for most of Wall Street and most CEOs and management teams is yes, we actually would like to jump off the cliff together, because it's a lot more enjoyable and comfortable to be together in a herd than it is to be the lone wolf and the voice in the wilderness saying, wait a second, this doesn't seem right. And you saw that in the late 90s with the tech bubble. You saw that in 08 and 09 with the financial crisis. You saw that you saw that in 1987 with the savings and loan crisis. So a lot of this stuff gets priced in, and that's why contrarianism works. Now, let's go back to our equation just real quickly. I want to go to our forward price earnings multiple. I want to go to our net income. What impacts these two factors, the 15 million and the 20 times? Well, Ben Graham, who is Warren Buffett's mentor, essentially said that markets in the short run are a voting machine. That means that they go up and down based on how people feel that day, how Wall Street feels, what people think about the, just random little things that can come up through a quarter that influence earnings. That's what influences the 15 million. It's a voting machine. I'm sorry, the forward P multiple. It's a voting machine. Is the market worth 18 times? Is it worth 25 times? Is it worth 20? That's the big what if factor. But in the long run, as Ben Graham points out, it's a weighing machine. And what are markets weighing on a company? Well, we're weighing the viability of the company's profits. How good is their business model? In accounting, we call it the going concern. Is this company going to be around for a while? That's what's impacting these two factors. And so what we really want to focus on is fundamentals. We want to buy companies that can grow that 15 million over time. And what we don't necessarily have to worry about on a short-term basis is what is that 15 million worth? And so when you go through a couple of periods of time now, and I think this is very helpful to see just the past few years, especially this march through the wilderness, as I've called it, I take this hypothetical company in this table, and essentially what I do is take the actual 2-year treasury rate at the time. That's what we discount earnings and the PE multiple by. And then we take the actual PE multiple there in that column PE multiple and multiply earnings by that PE multiple. And so what you find out is that we've gone through sort of this bumpy time in the stock market. And so in 2019, this company would have made about $10 million in earnings. We only had a 2.25% treasury yield. And so the PE multiple on the S&P was about 18 times. This company would have gotten a valuation of $180 million. You remember what happened in 2020, of course, where rates got cut because COVID happened. We pumped all this money into the economy. That company also was shut down temporarily. Remember the lockdowns, and earnings on the S&P dropped across the board 15 to 20%, sometimes 30, 40% if it was a hospitality company. Remember the cruise lines, remember the restaurants, and all the TSA checkpoint data that went to almost nothing. Well, what happens during a recession, and that's what we had during 2020, is not only do you have earnings go down, but you also have PE multiples go up. And this is really important to understand because the people that got bearish in 2020, they understood that earnings were going to go down, but they thought the market was going to plummet on a valuation basis. And in fact, the absolute opposite of that happened. Yes, we had a decline in earnings, but we all understood that markets are a forward-looking indicator of what's to come. Well, what does that mean in the COVID case? Well, it meant by 2021, we were going to go back to normal. We were going to go to, we were going to unlock the economy, and we did. We went back to slowly but surely back to normal. And the people that said cruises were never going to happen, that restaurants were never going to reopen, that casinos would never be back in business, got that wrong. And so the market became worth more in 2020 because it was discounting the future. And again, this is why that market equation is so important to understand. That company actually became more valuable. This hypothetical business went from $180 million in valuation to 224. And as you started to march through these wilderness years, 2021 started to normalize. Rates went back to a more reasonable rate at that 2% zone. The company actually earned more money in 2021 than ever before. It earned more than 2019. So despite the doom and gloom in 2020, the company continued to grow earnings and profits. And that's what happened on the S&P. And then those earnings normalized, the valuation normalized, and that company went up a little bit more. It went up to 252 million in valuation. We all remember again, though, what happened in 2022. And markets peaked out in December of 2021, going into the new year, going into 2022. Why? Because the Fed started to aggressively raise interest rates. But by the time you had a chance to react, you really didn't have a time to react. The markets really just took back off to record highs in 2023. But before you had a chance to react to all of this, the Fed was already starting to raise interest rates, already signaling, hey, rates are going to go higher here. And because of that, markets started to correct early in 2022. What happens when rates go up? Well, in the short term, valuations go down. It doesn't really matter what fundamentals are on a quarter-to-quarter basis. Like in this example, the company actually made more profit in 2022. That's true of the S&P 500. but the valuation we placed on those profits goes down temporarily because people are saying, hey, wait a second, I can get 5% risk-free on a treasury. Why am I going to go take risk on an equity where they may not be able to grow their profitability 5% or more per year? That's where that's where we were in 2022. We're coming out of that today, but in the short term in 2022, because rates were expected to rise, they were going to go up. Nobody knew where they were going to go for sure, but because they were expected to go up, companies became less value temporarily. That's why you saw a correction in 2022. And so this hypothetical company went from being worth 252 million to being worth 208 million. Last year, 2023, we saw a recovery in the stock market, not only because profits were going up, but because of the future expected path of interest rates. And again, I'll go back to something I keep hammering home, which is markets are a forward-looking indicator of what's to come. So even with record high interest rates at 4.85%, record high over the past 15 years, I should say, even with high interest rates, you ask yourself, how in the world could markets go up in 2023? Well, because we think at some point in the future, rates are going to go down. And they've already started to go down a little bit. You've seen with your pension, if you could take a lump sum pension for your company, you saw the value go down in 2023. Well, now those values are actually coming back up a little bit. Interest rates are falling. And the same thing is true with the bond market. It's expected that yields are going lower in the future. And we're going to come back to this in a few more slides. So don't forget what we're talking about here. 4.7% 2-year treasury, $15 million in earnings. Where we're at today in the stock market is about a 22 current price to earnings ratio. And based on where earnings are supposed to grow next year in 2025, that actually puts the market at a fair value of 20 on a forward price to earnings basis. So let me just back up a second and let's do this all again, that same exact slide we were just on with this hypothetical company. And let's actually talk about the real S&P 500 level. This is exactly what you've seen since 2019, rolling into 2024, and what our expectation is for 2025 is the simple fact that stocks, the stock market, companies are not radically overvalued today. They're not completely undervalued like they were in the COVID era. They're not undervalued like they were in 2022 when the S&P was 3,500 points, when we said bye baby. Remember, we put out that article, buy as much as you can. Stocks are cheap. We've continue to try and tell you this, buy stocks when they're cheap, because they're going to go back up eventually. They're going on to new highs. And sure enough, they did. And so where I think we're at today is analysts expect about $245 in earnings on the S&P 500. We're currently multiplying those earnings by roughly 22 times. That gets us a price or a fair value on the S&P at 53.90. But because we think that rates are going to fall to the low fours next year in 2025, and because we think profits are going to go up from 245 to 310 next year, that's the estimate that Wall Street expects, not for 2025, but for 2026, because remember, markets are a discounting mechanism, what's to come. We're going to actually multiply 310. I believe, this is my opinion, that we're going to multiply $310 in earnings times a 20 PE multiple. And so that's why I think, not to give anything away here for the rest of the show, but that's why I think by 2025 or even mid 2026, we are going to trade the S&P at 6,200 points. And the reason all of this math is important, the reason all of this data matters, is because we're in an election year. We're in a time where we've got some geopolitical conflicts. We've got a lot of noise going on. We've got a lot of the media trying to scare us off our financial plans. You got to hold on to this math when we're going through these volatile times. And so just either take a screenshot of this. We're going to have a recording available on YouTube, but just keep that 6,200 number in the back of your mind. Now, I could be wrong, and maybe we don't get there next year. Maybe we don't get there the year after, but I do believe the S&P will be above 6,000 points in short order. And you're going to be happy that you stayed on your plan. So just remember this, because we are going to go through some volatility, I think, the rest of the summer and into next year. Here's why you have to own stocks. And what I did here was I went back to 1964. We looked at the S&P 500 and where it was 60 years ago. And we said, okay, what was the treasury yield back in 1964? What did the 2-year yield? Well, it was 4%. Sounds pretty familiar to today and next year's expectation of 4.25. But the S&P back then, companies earned $4 across the board in earnings. And the S&P 500 index paid about $25 out in dividends. So the entire S&P 500, I know this is hard to believe, but the entire index only traded at 85 points in 1964. Well, look at where it's at today. Today, we don't produce $4 in earnings. We produce $245. We have $71 in dividends. The market trades at 5,450 points, and yields are almost the same as they were in 1964. All of you on the call today who have the benefit of perspective can think back to your mortgage being 10%, 12%, 15%, even 20%. You may even remember CDs when they paid 28% in interest. And so the idea that interest rates are going to push us off and we're going to lose our way because interest rates are higher than they've been in 15 years, we're only up in the stock market because of the Federal Reserve, is just based on a lie. It's just nonsense. It's not based in the reality of the market math. And so I just go back to basic math again. And I say, if you put $10,000 into the stock market in 1964, you turn that 10 grand into 1.7 million, almost $1.8 million. So if you're going to be in one asset class for the next 60 years, if you're going to be in one asset class for the next 5 or 10 years, you got to be in stocks. And we're going to talk about which ones. We're going to talk about which pockets of the market are attractive, in my opinion, today. But why do you want to own stocks? Because they have the power, like no other asset class on earth, to beat inflation. Why? Because companies raise their prices in real time to deal with higher input costs. You saw it at McDonald's, you saw it at Taco Bell, you're seeing it at Procter & Gamble, and Johnson & Johnson, and all the personal products we buy, and all the restaurants, and all the grocery stores. How are companies still in business with 40% more monetary supply in the economy? Simply because they raise their prices to protect margins. And so if you're a politician, you should take a basic finance class, which I don't think most of them have done. And they would learn in that basic finance class that if you print 40% more money in the economy, something that's happened to other two types of presidents, red and blue, you actually deflate the value of each incremental dollar. And one of the people that has pointed this out the best is Brian Westbury, First Trust Portfolios. We're going to have one of their economists actually at our investor day in November. You got to come see him, Andrew Opdyke. But Brian Westbury pointed this out and said, your stuff doesn't cost more. That's something we hear about all the time. Your stuff doesn't cost more today. Your dollar buys less stuff. That's the reality of what we've done, especially the past 40 years or 4 years, with 45% more money supply in the economy. But this is not a new phenomenon. We have inflated the value of goods and services by about 3 to 4% per year over the past 200 years. And the only ability you have to beat that over the long run is by being in companies that raise prices in real time. So stay in the market, stay in equities. What's driving the bull market today? And I do think we're in a bull market. I think we're in a secular bull market that's going to continue for a while. We'll talk about how long I think that's going to continue. But what's driving the current bull market? It's a thing called sector rotation. And we talked about this going into 2024 in that December market outlook for the year webinar. You can go watch that on YouTube if you're interested, or I think it's on Spotify and Apple too, but go watch it on YouTube. And what we talked about was that not only was technology going to continue doing well in 2024, but you were also going to see a rotation back through the different sectors. Remember, the S&P 500 is 500 companies. It's not just technology. It's not just NVIDIA, despite popular opinion today. It's not just the Mag 7, it's a bunch of different companies. We've got communication services, we've got utilities, financials, all the bank stocks. We've got the consumer staple stock like Procter and Gamble there. We've got industrials like GE and John Deere. We've got healthcare companies. Of course, we've got energy, we've got material, we've got all these different sectors that make up the market. And what you're seeing happen, not only with returns, but also with earnings, is a recovery across all these companies. Not every company in the S&P 500, but a lot of them are near 52-week all-time highs. They're making new highs on a regular basis, not because it's a fugazi, not based on just because we think rates are going to go down, but because they're producing record profits. And so across the board, if you hand select the top companies in each one of these sectors, you end up with a phenomenal portfolio. You've got companies like Microsoft, you've got Meta, which is the old Facebook, NextEra Energy, the utility stock. We've got Berkshire Hathaway, that's Buffett's company. We've got Procter and Gamble, GE, Eli Lilly, ExxonMobil, Chevron, Conoco, Linde. We've got Amazon, we've got Prologis in the real estate sector. So we've got a bunch of companies where we're starting to see returns widen out. That's a positive thing for markets. But the question is, why are technology stocks, why is the Mag 7 producing more outperformance than the rest of these sectors? Well, the basic answer is, first of all, they're producing insane amounts of profit. I mean, it's crazy the kind of profits that they're producing. But it's also because their profits, according to Wall Street, according to investors, are more valuable than some of these other companies. And one of the reasons for that is because tech companies have this thing called reoccurring revenue. It's not transactional revenue, or it just happens on a one-off basis, but it's reoccurring, which means that there's a higher degree of predictability around what they're going to make, not this year, but what the markets care about next year and the year after. You're starting to see this with financials now. Financial companies like Bank of America, JP Morgan, Goldman Sachs, they're starting to produce more predictable profits. And so you've actually seen with financials now, they become more valuable the past few years. And three of the companies that actually fall into financials that aren't really even financials anymore, they're almost like tech companies in a way, are the credit card companies. You've seen this with Visa, you've seen this with MasterCard, you've seen this with American Express. They have so much data, they have so much information, they have real-time data, it's predictable, reoccurring revenue. These companies like Visa, MasterCard, and American Express trade at 20, 30, 40 times earnings. Now, is that the right price for earnings? Could some of them be overvalued in the short term? Sure. But the point is that the market is telling you these companies are structurally more valuable over time. And you've seen this the past 5 years. Technology has led the way the past 5 years. Communication services has led the way the past 5 years. Financials have done well. Industrials have done well. Healthcare has done well. Even energy coming out of 2020 is starting to do well again. Materials has done well. Why? Because some of these companies are getting to a place of more predictable, reoccurring revenue that's more valuable. So I want to just take you through three quick examples of these companies and explain. And I'm not gonna tell you exactly to go out and buy these or put all your money into them or anything like that. Don't take this as investment advice. I just want to point out how strong some of these Mag 7 companies are. Three of them in particular. Microsoft today, just in their cloud business, is producing $129 billion per year in revenue. Unbelievable. Just LinkedIn alone. And you might have forgotten about LinkedIn here, one of the social media platforms, producing $15 billion a year in annual revenue. They've got a massive user base, 1.4 billion users. Is this a monopoly? Maybe, but so far the regulators haven't broken it up. And I would argue for all the people that are doom and gloom about the Mag 7 getting broken up, I would just say there's probably more value that gets unlocked in a breakup scenario than there is with all these pieces combined. And we've talked about Google in the past. If Google spins off Waymo, which is their driverless car technology, or YouTube on its own, or some of these assets they have are worth billions of dollars just on their own, and you're effectively going to end up as a shareholder of all of them, even if they do get broken up. So these are very strong businesses. They're not completely immune from the problems that can come up with valuation issues or recessions or anything like that. So don't hear me wrong, but these companies are structurally in a better spot than a lot of other businesses. That's why they're worth what they are. Apple, another great example here, sitting on a war chest of cash, $162 billion. That's more than the GDP of most countries. They're now earning 5% risk-free on that cash. I would actually argue that there's a lot of strong companies like Apple out there that are almost functioning as banks today. They have more cash on their balance sheets than most banks do in assets. Apple is producing $95 billion a year just in services revenue. That's reoccurring. It's strong revenue. It's predictable. Remember what I said earlier? That's why Apple is trading at the multiple it is. It's doing a buyback program of $110 billion. Now, do I have concerns about Apple's innovation long-term? Yes, I do. But I think when you talk about AI, when you talk about some of the revolutions that we're going through right now with technology, I do think Apple's going to still be on the cutting edge of this. Under Steve Jobs, Apple was a little bit more innovative. He was an innovator. He was an entrepreneur. Under Tim Cook is more of an operator, which means he's doing more financial engineering to get earnings up by buying stock back, by paying more in dividends. But that's not a bad thing for shareholders. And so you've seen Apple stock go up over 300% the past 5 years because it's a strong fundamental business. So don't forget the fundamentals behind these companies. These are insane numbers, quite frankly. Here's NVIDIA. We've talked about NVIDIA before. Earnings per share is up 629% just over the past 12 months with a and I think this is as of last week. It's down a little bit today, but about a $3.3 trillion market cap. And I should say only with a grain of salt, but only a forward price earnings ratio of 52, which if you went back a few years ago, this thing would have traded at 150 times earnings. And I'll give you another example that could trade at a high multiple for a while, which is Amazon. Amazon produced almost no profits for the longest time because they were reinvesting back into their company. Jeff Bezos appeared on The Tonight Show. He appeared on all these different talk shows, and they actually made fun of him and said, Amazon doesn't make any money, and you guys are losing $5 billion and all this stuff. Well, he ended up getting the last laugh because he was reinvesting in his company. They were using AWS, which is Amazon Web Services. That's their data business, their cloud business, which happens to be one of the biggest ones on earth. It might be the biggest, I think, now, but they were taking all the profits and cash flow from AWS and then using it to essentially become the biggest retailer on earth. And it's not even really a retailer. It's more like a big data company, which is essentially what Walmart has become as well. And Amazon traded at a 60 price to earnings ratio for decades, 70 times, sometimes almost no earnings because they were reinvesting in their company. So I'm not telling you to go take your entire net worth and put it in NVIDIA. And there certainly could be a downside. NVIDIA's had like 3 or 4 50% plus corrections in its stock market trading history, but that doesn't mean that it's a bad company in the long run. It doesn't mean it's necessarily overvalued if we check back in on it in 5 years. And so my point is, again, not with any of these companies, I'm not saying go buy them or put your entire net worth into them or anything like that, but I'm just pointing out the fact that they have strong fundamentals. You may hear this and remember, the bigger the PE multiple, the harder these stocks are going to fall in a correction. Tesla's a great example of this. It's down 33% the past 12 months. And a lot of people are looking at companies like Tesla. They're looking at Elon Musk, and there's half of the people out there that I guess hate Elon Musk now, which are the opposite half that used to love him. And so that's a fun little dynamic to watch as well. But Tesla's down 33% the past 12 months, and people are saying, oh, the sky is falling for Tesla. Well, I always mention the fact that when in doubt, zoom out, and you got to look at a longer time frame. You have to do this not just with Tesla stock, but just the market in general. Because if we do correct from 5,400 points on the S&P like we're at today, and we correct back down to 4,500 or 4,600 temporarily, you got to remember in 2019, the stock market S&P was only trading at 2,900 points. So you got to look at a longer time frame. You can't just take that all-time record high statement value and compare today to that. You need to have some perspective on where we've been. And so over the past 5 years, Tesla is up over 1,000% still. Elon's produced incredible results, incredible value for shareholders. That's why he got that $56 billion pay package. You may be thinking to yourself, why does Elon get $56 billion? That's a just insane number. Why does he deserve that? Well, shareholders made a deal with Elon a few years back and said, if you continue to deliver these profits, if you continue to innovate, if you continue to grow Tesla, we're going to reward you with $56 billion. And so the fact that was even contested and that people brought that to court was ridiculous. He has produced incredible results for shareholders. Now, I'm not going to say that Tesla doesn't have problems. I'm not going to say they're immune to the issues that we're going to see with the broad economy if we get into a recession or anything like that. Obviously, car companies are subject to all the same volatility the rest of the market has, and maybe even a little bit more. But I do want to point out the fact that Tesla is not just a car company. And again, you have to peel back the hood of what you're buying. You've got this incredible asset, which is driverless car technology. And this is coming. You may think it's crazy. It's never going to happen. We're always going to have human drivers forever. But actually, I think where things are going is the insurance lobbyists. Now, this is a very long call that I'm making. So I don't think this is going to happen next week or next year or anything like that. But I think the insurance lobbyists are actually going to go to Washington. They're going to say driverless cars produce less accidents and less death than human drivers. And even if it's 10% less or 15% less, it's good enough for the regulators. And I actually think that Elon is playing a long game on AI, a long game on driverless cars. And it's very possible that he licenses that technology to other manufacturers. And these cars with this driverless technology, if you go out and buy FSD, full self-driving on a Tesla right now, you're essentially providing their company, you're providing Musk with all this data, and that's what they need to improve their systems. And so I think that again, not telling you to go put your entire net worth in Tesla or buy a bunch of it or buy any of it for that matter. I'm just telling you, be careful what narrative you listen to, because if you peel back the hood, you look at the data mass statistics, you look at what's going on behind the scenes, I think you're going to be just absolutely stunned by some of these numbers. The other thing that Musk is doing is I believe is inspiring the next generation of Americans. And you remember JFK with the flight program. You remember Ronald Reagan inspiring Americans. You remember these presidents throughout history who really got the next generation excited about the future of our country. Well, we really have not had a politician that's done that in a while. We've had politicians that criticize the other side. We've had politicians that paint a doom and gloom narrative, but we just have not had the politicians that we used to have that would inspire people, that would give them a vision. And I think what Musk has done is he's given the next generation of Americans a little bit of a vision. He's inspired them. And if you don't think so, just look up the Starlink technology, look up Neuralink, look up the Boring Company, where they're literally drilling holes in the ground and cutting traffic wait times by 2/3. And even further than that, look at the rocket system, the rocket program that Musk has got going here. And what we're doing today, what Tesla's doing is sending these rockets up, reusing them, and the implications are huge for international travel. The idea long term, again, very long term, but the idea would be is that you could fly essentially from Chicago to Tokyo in a few hours compared to overnight. And that's a huge deal. So just understand what's going on. These entrepreneurs, what's going on underneath the surface is just incredible. And I do think it's part of the reason why shows like Shark Tank have just absolutely taken off and are so popular, is because people are watching these entrepreneurs. They're watching people like Musk, and they're saying, I can do that. I can see how somebody can see a problem that's going on and make it better, and they're getting inspired by that. So this is neat stuff. You don't have to love Musk. I'm not saying anything like that. He's got his problems just like we all do, but it is just giving the next generation of Americans something to be excited about, which is pretty cool. So here's what I want to also point out with the Mag 7, and you could even call this, there's the Great 8, there's the Mag 7, there's a bunch of different ways to slice and dice these top companies. But what I want to do is just compare the price to earnings ratio. What are these companies valued at compared to the rest of the market? And then what I want to do is compare that to history over the past few years, because a lot of people are saying, Nick, this is just like the late 90s. This is another tech bubble. We're going to have another bust where companies are overvalued. So here's the top companies in the S&P. We've got NVIDIA, we've got Microsoft, we've got Apple, we've got Amazon, we've got Facebook, Google, Tesla, and Netflix. And the forward price to earnings ratio, if you average them out, is about 39 times earnings. And you think, wow, that is radically overvalued. There's no way that's sustainable. We got to have a correction. And I'm not disagreeing with you. I do think we're going to have a correction at some point. And of course, these companies will correct a little bit more than others. But I don't think if you look at some perspective, if you look at the past 5 years, I don't think they're radically overvalued compared to where they were. And in fact, in some of these cases here, these companies are actually cheaper today than they were 5 years ago. And they've got more revenue and more profit than ever before, certainly more than they had 5 years ago. So on average, these top companies are only 3% more pricey than they were 5 years ago. And if you take out the top, this is actually the top 8, the great 8, as we'll call them, and you go even X Mag 7, X grade 8, you're looking at a 17 price to earnings ratio versus a 16 average the past 5 years. And so that's why we've said you got to have a little value in the portfolio. You don't want to be completely in growth. You don't want to be completely in technology. Of course not. We think the right mix is about 60-40. That's a little inside baseball for you. We like about 60% in growth and 40% in value, because during rising interest rates, value does outperform. We've seen that the past few years. But the bottom line is the 492 are in the S&P 500 are only about 6% pricier than they were 5 years ago. That shouldn't be something that scares the pants off of us. And so again, I don't think stocks are radically undervalued today, but they're certainly, if you look back at the past few years, not radically overvalued either. And then what I did here is on the right, I put up the S&P PE ratio going back to 1999. And what I would tell you is that we're in the early innings of a bull market that I think can last for years to come, with one qualifying factor, and that's that fundamentals do well. That means that earnings, remember the earnings times price equation, going back to the very beginning of today's presentation, the earnings have to continue doing well. What we saw in the late 90s and even the early 90s was we saw stagnating earnings. Earnings were really not growing. Profitability was about the same the entire time. And instead what we had rising valuations. We had expanding multiples, and we had stagnating earnings. When you get into a scenario like that, that is when you should get nervous. But the problem is if you try to time that out and you try to say, okay, I'm going to buy the S&P at 22 times earnings and I'm going to sell it at 30 times. Well, first of all, again, the market's a forward-looking discounting mechanism. What's to come? So by the time you figure it out, it's going to be too late. The other issue is the market can stay pricey for a while. And you saw this in 1991 with the S&P trading at 15. That was a screaming buy. If you were around then, you should have bought like we did. 1992 market got a little pricey. You could have said, hey, market's overvalued in 1992 at almost 26 times earnings. But the problem is by 1998, the market was still about 24 times earnings. There was some earnings growth. You saw in 1995, market only traded for 15 times earnings, which again was a screaming buy. And if you bought each and every one of those years, if you stayed invested across that entire time frame, even with the tech bubble, with the tech crisis, even with all these stocks that got revalued a little bit lower in 2000, you still made 7% annualized returns by holding across the entire decade. So again, I go back to the basics of what we tell our clients, which is stay invested. Don't try to time this out. Don't try and be smart enough to know when to get in and get out, because you may be right on the way out, but the problem is you got to figure out when to get back in. And by the time you got back in, let's say you got out in 1992, you got back in 1999. Well, you did the opposite of what you should have done, which is buy low or buy high and sell low. So that's the exact opposite of what makes a good investor. So my point with this is just to say, yes, stocks are a little bit pricier today than they were 5 years ago, not radically pricier, but they could stay at these valuations for a while. And that's why you got to keep holding on, and you got to stay on your plan. What's also happened the past few years is you've seen this absolute difference between the top 50 names and the bottom 450. And so the top line here, if you're following along and watching this, is the blue line, which is the top 50. The bottom line is the red. You've seen the top line produce 130% in total return the past 5 years. The bottom 450 have done 100%. That 30% difference is important. It is pretty significant. But what I really want you to pay attention to is when those two lines started diverging. In 2019, and you see this in the early part of 2020 before COVID struck, the bottom 450 companies actually performed pretty well relative to the top 50. Those two lines track each other pretty closely. In 2020, though, what happened was when we locked down the economy, the government essentially picked winners and losers. And what I mean by this is we let Amazon keep operating. We let the big box chain stores keep operating, like Walmart and Home Depot. And I'm not saying this is good. Actually, I think it's bad. But this is the reality of what the government did. We picked these winners and losers. We closed down mom and pop stores. We told small family-owned restaurants you had to shut down. And so companies that were larger and had better balance sheets were able to ride that storm out. They were able to ride out those lockdowns a lot more effectively. And it's a trend that's really hard to reverse because remember, you've got companies like Berkshire sitting on $186 billion in cash. You got Apple sitting on $162 billion in cash. And so just in net interest alone, the money they make in interest on that cash alone, they've got a more coming in interest than most of these small and mid-cap companies have in revenue. Let that really sink in. And so that's the reality of being an investor is the big do get bigger over time. And so again, will this continue forever? Maybe, maybe not, but certainly in the big government environment we're in today, where we have lots of regulation, we have the government picking winners and losers, we have the tax rates we do, it's very important to understand the fact that the big will continue to get bigger. And I think that's a phenomenon. It's not great. It's not something we should love, but it's just a reality of being an investor. And so that's what you've seen here the past 5 years. Small caps have also been hurt by interest rates. And a large company that has $160 billion on its balance sheet, again, doesn't have to go out and finance projects. They can just pay cash for them. They can buy companies. They can get stronger during these downturns. A lot of small caps that were already struggling are now going into banks, if they can even get financing at all, and they're borrowing at 10%, 12%, 15%. It's very restrictive for growth. And so again, if you've been following us here the past couple of years, I've told you, watch out for these small caps, watch out for the mid caps, because the difference is major. Look at large caps. That's the blue line on the top. Large caps have produced more than double the return of small caps now the past 5 years. And I do think that's a trend that's going to continue, and it's not going to reverse until we get interest rates significantly back under control. But remember, when the Fed talks about lower rates, or economists talk about lower rates, or Wall Street says, oh, we think we're going to get cuts. Remember, we're cutting from record all-time highs. We're cutting from 5.5% or 5.25% on the federal funds overnight lending rate. We're not going back to 2% unless we have a recession. And going into a recession, small caps and mid caps get decimated. And again, that's another reason why we like large caps, is because large caps tend, not always, but tend to protect us on the downside as well, just because they do have better balance sheets. And I think the top 50 are even better than the S&P 450. Let's talk about one of these companies. I've got the truck behind me if you're watching along, the Walgreens truck. And this is a really kind of sad example, but in 1984, I broke this down into two time frames, 1984, and it's actually 2024, but two sets of 20-year time frames. The first being 1984 to 2004, where Walgreens literally produced a 21% annualized return for those 20 years. Walgreens was the darling of Wall Street. It was growing every year, opening up new stores, and just an absolute booming company. You saw this with other stocks like ExxonMobil. You saw this with General Electric. and just this absolute growth machine in the US stock market. Walgreens was almost like the Nvidia of its day. It was really innovative. It was just a very well managed company. Well, they had a couple of things change, and instead of producing 21% annualized returns like they did from 1984 to 2004, 2004 to 2024, the past 20 years now, Walgreens has only produced a return of 0.5% per year. Well, a couple things happened. Number one was Amazon Pharmacy was announced a few years ago. And then the second thing that really hurt them was they had to pay a $5.7 billion settlement with the opioid crisis. And they got wrapped up with Purdue Pharma and all the rest of these companies that had some issues. And that has really changed the game for Walgreens investors. Not only are they having growth problems because of Amazon Pharmacy, but they're also having growth problems because of their balance sheet. They used to have billions of dollars in cash available. They're down to just under $1 billion in cash now available on their balance sheet. And you think that sounds like a lot of money, but it's not for a company with thousands and thousands of employees that have to make hundreds of millions of dollars in payroll. And that's the concern with some of these companies. So it's not to say go out and short Walgreens. There might be a turnaround story, and who knows? Who knows what happens? Maybe Amazon buys them for all we know. But the point of this chart is just to show you that this stuff can change, and that's why you have to rebalance. That's why, in my opinion, you really have to watch what you're owning. That's why the meritocracy of a market cap weighted index, meaning the biggest and best companies rise to the top over time and the lowest companies get kicked out of the index, is such an important thing. That's why the S&P continues to do well, is because we're taking companies that used to be at the top. Walgreens literally used to be a top 10 name, and then watching those companies shift down to the bottom 10 names in the S&P 500. So you just want to make sure you own them when they're strong. And then if they stop meeting some of that quality criteria, remember we used to call it the wilderness years. Now I've been calling it the jungle years, which means I think we're going to see great returns in the S&P, but you just have to have some quality metrics on these companies, because when you got higher interest rates, not every company behaves the same way. And that's what you're seeing here with Walgreens. And then one of the last charts I'll show you before we get into some Q&A, if there are any questions. I think there are a few that came in ahead of time. If you think of anything while we're finishing up here, just go ahead and throw it in the Q&A box in front of you on Zoom. But the U.S. continues to beat the pants off of every other geography on Earth. And again, the S&P is up about 100%, a little over 100% the past 5 years. China's down 20%. Japan has done okay, especially if you strip out the currency. It really has not performed anywhere close to the U.S. It's performed more like Europe. Europe continues to have massive problems with innovation. They've got a couple of good names over there, a couple of great companies that are really impressive, but it's hard to scale that out across the entire continent. China happens to lock people in prison, and that tends to make people not want to grow businesses and be innovative over there. So all the smartest Chinese are here with us in the U.S. All the smartest Japanese are here with us in the U.S. All the smartest Europeans are here with us in the U.S. The Africans, the Latin Americans, they're all right here. And the other thing you don't have to worry about is when you're buying U.S. companies is the fact that you don't have to get that money back to dollars. It's already local currency, and some of the efforts that President Trump took with the trade war and all the rest of it with tax rates and tax regulations effectively allowed companies to bring their dollars back to the United States. And so that's another reason why the U.S. has done well. I think one of the spots you could see in the emerging market world that could perform are places like Argentina, places like India. And the reason why is policy. And so part of the reason why the U.S. has done well, maybe one of the biggest reasons, is because we do have really good policy. Yes, we've got high tax rates when you combine local, state, federal all together. Yes, we've got a lot of regulation, but we still have the rule of law and personal property rights. And you're seeing countries that start to embrace these ideas, that start to embrace capitalism, perform Well, India is a huge benefactor of the trade war with China. When these CEOs leave and take their businesses out of mainland China, they go to India, they go to Mexico. The US-Mexico trade partnership is the largest in the world now. It's just incredible what a trading partner Mexico has become. We've got friendly neighbors with them and Canada. And we also do have the oceans separating us from a geography standpoint from our adversaries, which is very helpful. We have the most fresh water on Earth. So we have a lot of really good stuff going for us. But India happens to be embracing a lot of pro-capitalistic policies. And I think India is a bright spot. Now, do we want to go buy Indian companies? I don't think there's enough to go buy. That's why we've been cautious and waiting on this. Argentina under Javier Milei really has turned a corner. And you saw Javier go into I think he was in front of a blackboard and he had all the different government departments written on the blackboard and he just rips them off one by one and said, we're going to slash this, slash that, slash this, all this big government spending. And that's what the U.S. has done over time. We've gone through these phases of big government, lots of spending, blowing out the national debt, spending way too much money, putting way too much money on our government credit card. And what do? Well, then we have to grow. We have to get our fiscal house in order and we have to shrink the size of government. We've done this many times over the years. Coming out of the 60s and 70s, we did it under Ronald Reagan. We did it again under Bill Clinton and the Republican Congress. We've had a lot of big government under President Bush and President Obama, and of course under President Trump and President Biden. So I really think what's coming in future years is we are going to shrink the size of government. I think we are going to pay off our debt. And I do think we're going to get back to balanced budgets. And so I know this sounds very contrarian. I know it sounds like the exact opposite of what you would expect. But the reality is I do think we are going to return to a lot more of a normalized political environment. I do think that's where we're headed. So the U.S., in my opinion, is going to continue to do well. Let's just wrap up here with this chart. I want to talk about gold. You say, Nick, you said that equities are the best hedge against inflation. I thought gold was the best hedge. Well, here's your simple problem with that idea. Gold is not an inflation hedge. You got to understand this. Gold is a dollar hedge. So when the dollar is strong, gold does well. You see this chart in front of you here. The red line is the dollar and the blue line is gold. And so when the dollar is strong, the gold does well. Okay. And when the dollar is weak, like it was a few years ago, gold actually doesn't perform very well at all. And so I think what you're seeing today is that gold is at record highs, not because inflation is at record highs, but simply because the dollar is still very strong. And so I think you're going to continue to see this phenomenon. We've certainly seen it the past 10 years. It's going to continue. And just be careful. You can't take your gold bars and turn them into groceries. Okay. You can't turn it into a new Toyota Camry. And so the only way you're going to do that is by converting back to US dollars. And for now, the dollar is still king. Okay. And the dollar is, I think, going to remain number one for a long period of time. We've had all these doom and gloom stories over the years. The dollar is going to fall apart and it's going to be replaced by something else. But really, the dollar is the best house in a bad neighborhood. It's much better and less manipulated than the yen. It's much better. It's much more stable than the euro. And I think I really think we're going to see U.S. companies and equities continue to outperform gold over time. We've certainly seen that the past 200 years. Dr. Jeremy Siegel wrote the book on it, Stocks for the Long Run, and it didn't just go back over 10 years here like this chart, but he went back 200 years, and equities have beaten gold over the long run. So again, I'll just recap what we said at the beginning. I think we're looking at $310 in profit for 2026. I know it's a long range estimate, but that's what we look at. We look at not this year's profits, but next year's. I think we're going to multiply that profit by about 20 times earnings, maybe even a little bit more. But I like to go conservative. And I think if you multiply 310 by 20, you're going to end up with an S&P right around 6,200 points. So if you've got cash that you're looking to get to work, get at least some of it to work now. I think you're going to be up in a few years. If you're thinking about, Nick, when do I panic? Do I panic right before the election, right after? When should I get nervous? The answer is don't let politics get in the way of basic math here. companies are still going to produce profits under both types of presidents. They're still going to produce profits under both types of Congress. But really what we want to have happen, and I saw this came in as a question, so I'll just jump ahead a little bit and to say that really what companies, businesses, the economy wants to see is gridlock in Washington. We just don't want to see a whole lot of anything happen in either direction. So that's where we end up with 6,200 points on the S&P. I'll stop there, and Audrey, I'll let you jump back in here if we've got any questions.
All right. Thank you so much, Nick. That was awesome. Like Nick mentioned, we will be taking a few questions now. And if you've thought of anything that you'd like to ask, please go ahead and put your questions in the Q&A section, and we'll try to get to it. And if we aren't able to answer your question during the live podcast, we'll be sure to get your question answered off of the recording. So first things first, let's start off with a question that came in just ahead of today's call. Nick, one person asked, will the stock market crash if NVIDIA loses its momentum? What do you have to say there?
Yeah, good question. A lot of talk about NVIDIA lately. No, the answer is no, it's not going to crash. NVIDIA is about a 6% weight in the overall S&P. So there's still 94% left to hold up stocks. And again, you're seeing the sector rotation across the market. You're seeing other companies produce great earnings. JP Morgan, not the most exciting company on earth, and I guess they're using some AI right now to help their operations people. It's not a .ai company. It's not one of these companies that you think of as being a tech company, but they're using technology. And so you have to remember the market is made up of all these sectors, all these different companies, and they're going to produce profits for different reasons. So some of them are the guys who are actually going and making the technology, and some of them are the ones who are using it. So no, if NVIDIA struggles a little bit, it's not the only thing holding up the market. And I do think for the rest of the year, and certainly this is true across history, you actually don't see the top companies mean revert to the rest of where the market's at. You see the opposite happen. You see the companies that haven't produced as good of returns as the top actually come up and participate in those returns later throughout the year. And so there's some great stats out about this that you could actually see a little bit more of a rotation where yes, Apple, Amazon, Microsoft, Facebook do well for the rest of the year, but some of these other companies that are going to use that technology, like Procter and Gamble and JP Morgan and ExxonMobil and all these other stocks, are actually, I think, going to return to some brand new all-time highs by year end, and certainly going into next year. So you actually see this rotation across the market. It's not just NVIDIA. I think you're going to continue to see it across all these different sectors.
All right. Thanks, Nick. That was great. Again, we'll wait for a few more questions to roll in, but in the meantime, Nick, we had a question on home prices and the housing market, and home prices are currently high. The question is, do you think they will continue to go higher, or do you think that they will level out since there will probably be some additional supply once interest rates are eventually cut?
Yeah, I think home prices will go up, but not because of anything to do with interest rates necessarily, but more so what the supply of money does. And so again, if you get lower interest rates and major cuts, I'm not just talking 0.25% to the downside or 0.5% to the downside. I'm talking serious cuts that people are really saying they're hoping for. I would just say as a warning, be careful what you wish for, because if you get serious cuts, if you have interest rates go back down to 1% or 2%, there's usually a reason for it. And the reason would be a recession. So in a recession, home prices will not do well. You, of course, remember 08 and 09 and the housing bubble and all the rest of it. I don't think we're necessarily going to get these major cuts that people expect. The U.S. economy has been extraordinarily resilient, even through COVID, even through some of these things we've had. But I think more so the policy behind the housing market needs to be addressed. And one of those things is all these corporations buying up housing foreign investors that have been allowed to come into our major cities and buy housing, and that's inflated prices. And then you've got companies like, actually, I won't name any names, but we do have some major investment companies that have bought a lot of residential housing, and that's pushed prices up too. I think that's kind of crazy, actually. I think we need to look at some of the policy we have and why we're allowing, for example, foreign actors to come in and buy apartments up. There's actually a lot of reports of Chinese billionaires, for example, who will buy a beach house in Malibu for $50 million and then change their headquarters to that beach house in Huntington Beach or wherever it might be, Newport Beach, Laguna, Malibu, wherever it might be, just to get money out of their country. That's a crazy thing. And we really need to think seriously about that. But the other thing, too, is, again, the big get bigger. And so if you already had $10 million and you go up 10% on your net worth, that's a lot bigger of a jump than having $100,000 and also going up 10%. So part of the reason why these asset prices keep going up is because money gets devalued, and because of that, our dollar buys less house. And so I don't know if interest rates really help us that much. Interest rate cuts. I think what you need to see is wage growth. You need to see the economy do well, and hope that people don't lose their jobs. I think really what the driving factor is going to be is layoffs. And we've been talking about layoffs since last April. And even software engineers now that you were, at one point untouchable. You never thought that a software engineer could get laid off, especially during COVID in 2020 and 2021. Well, the opposite has happened now. This is one of the worst times ever to be a software or technology person. And part of the reason is because these companies overhired in 2020. They overhired in 2021. Facebook, there were reports that they had people that were in charge of goat yoga. And, you're thinking to yourself, why do we need somebody making $300,000 a year to lead yoga class? Well, Facebook figured that out too. And so they're really trimming the ranks. They fired 10,000 people. I think they did that twice. Tesla is doing the same thing. You're seeing all these big tech companies that are coming back to normal. They're normalizing where the labor market is. So I think the bigger factor with housing is not necessarily interest rates, but I think it's what happens with the broader economy. And do you see people lose their jobs? Because that could be a problem. If you see a serious layoffs, then you could have a recession, and then rates get cut, and that's when prices come down. So just be careful what you wish for with lower rates.
Thanks, Nick. We're going to take just a minute here, see if some more questions come in so we can get those answered. Again, go ahead and put them in the Q&A section. If there's a more personal question, we'll be sure to address it with you individually afterwards. But it's been great hearing from you thus far today, Nick.
Yeah, absolutely. And Audrey, I think you've got one more on the election as well, correct?
Yes. So we had this question come in, and it made us smile. So if the Fed cuts rates, and if they do it this fall, do you think it will be because of the election, Nick?
Yeah, great question. Yeah, I saw that one pop up, and it's interesting. How political is the Fed? How politically motivated are they? I think it's more than people realize. I don't necessarily know if we get a rate cut just because of the election. I think the election itself is sort of unpredictable here. We have no idea what's going to happen. So the Fed is just as clueless as we all are. But there is always the body bag factor. If Powell doesn't cut the interest rates here, maybe he does end up getting canned at best. Of course, he was Trump's guy. He was the Fed chair when Trump was in office too. So you've had he's caught some flack from Democrats as well, saying, "Hey, why are you keeping rates so high?" But Powell, I think, is more concerned about his personal long-term reputation, and the Fed is very motivated by that. And you saw this with Arthur Burns, and then you saw it with Paul Volcker, where Arthur Burns at the time was just loved. I mean, he was great because he cut rates quickly. He only kept them high for a little bit, cut them, but then inflation came roaring back. And so Arthur Burns in the moment was loved. if you actually go take an econ class at any university now, he's looked back at as one of the worst Fed chairs in history because he let inflation come roaring back. The opposite is true for Paul Volcker in the 80s. And Paul Volcker was brought in to clean up Arthur Burns' mess. Well, he was hated at the time. He raised rates to 19%, and he did what he had to do to get inflation down. We also cut the size of government. We cut taxes. We cut regulations under Ronald Reagan, and inflation really got back under control. And so again, Paul Volcker in the moment was hated. Now he's looked back as actually one of the best Fed chairs of all time. And that's what Powell is really looking at. If he has his way, he wants to go down as a loved Fed chair, kind of like Michael Scott in The Office. If you ever watch that show, and Michael Scott says, would I rather be feared or loved? And he said, I want people to be afraid of how much they love me. So that's what Powell's up to. Does he get another chance to wrap this up? I think probably, although he has been there for a while now. He's been there just as long as most of these Fed chairs have been. So it's probably time for him to move on. I would be more focused on who the next person is going to be. Trump is already said if he gets reelected, he wants to get back down to record low interest rates. Biden has basically said this, the same thing. And how much influence do they have over that? I don't know, but the reality is politics probably affect it a little more than people think, but also not nearly as much as it would make a difference. Again, we're going to be cutting from 5.5%, not to 2% and 1% most likely. So even a quarter point cut, maybe it helps in the short term, but it's not that meaningful in the grand scheme of things.
All right. Thanks, Nick. And quick follow-up question to that. Speaking of the election, who do you think is going to win?
Yeah, good one. Yeah, this will get me in trouble with everybody, both sides. But if you look at the polls, Trump's ahead a little bit. If you look at the economy, the general economy, remember there's a difference between the economy and the stock market. Economy's doing pretty good. It's chugging along. The stock market's doing incredibly well, but again, the stock market's a forward-looking indicator. So I don't think it's necessarily about who the actual president's going to be. I think it's more so what we think Congress is going to look like and overall DC next year. I think we're going to get gridlock in Washington. I think even if you don't get a Trump presidency, I think there's a good shot that you have Republicans in the Senate and in the House. And so even with the Democrat president and Republicans in a couple of the chambers, I think I think you have enough gridlock to really not see much happen at all. With gridlock comes higher profitability because you probably don't get many radical changes on the regulation side of things. You probably don't get many changes on the tax side of the equation. And that's what influences profitability in the long run. So I think probably what we're going to see is gridlock. And I wouldn't be too wrapped up in the presidential election. I'd be more wrapped up in what the overall makeup of Washington is going to look like. It's not really good for one party to control everything. It's good to have some divided government, and that's what markets like too. The other problem is we do have kind of a uniparty going in Washington. We have a lot of the Republicans that look basically the same as the Democrats. There's not a huge difference in policy between these two parties. You see some things on the social side, but really not a huge difference when it comes to economy, when it comes to money printing, when it comes to some of these major things that actually can influence markets on a policy standpoint. So because of that, what you tend to see in an environment like that, where everybody's feeling like, okay, there's this uniparty, the Republicans don't look much different to the Democrats, is you kind of end up with a Tea Party scenario, like a Boston Tea Party, where somebody from the outside completely comes in and shakes things up. So that's not really going to influence policy as much as you might think in the United States, because we do have checks and balances. Argentina, when you get that, or Mexico, when you get that, you see these wild swings. Craziest thing, just a little tangent here, but craziest thing you saw in Mexico was 30 of the presidential candidates were murdered in the election season before Claudio was elected. And that's kind of wild. I mean, that's insane. So as bad as you think it might be here in the United States, or you think Twitter is volatile and people are mean, Mexico's got some problems of its own. A lot of these countries out there have much worse political systems than we do. So number one, I'd be grateful for the system we have, and number two, we really do have a good system of divided government, and I think it's going to produce a continued growth for company profitability over the next few years. So I wouldn't get bearish either way. I think you're going to continue to see profits rise. You're going to continue to see companies do just fine. And especially that first year of the presidential election cycle coming off of the election. So that would be next year, 2025. I can't remember the stat exactly off the top of my head, but it's something like 90% of the time the market's up. And it's usually up about 12%, I think is the average. So I can check that stat, and maybe I'll mention it again in the next show. But the point is on the average, that first year of the cycle is very strong for equities. So my last message I'll leave you with is just stay the course and don't get caught up in politics.